This content is for educational purposes only. It does not constitute financial advice. Always do your own research before making any investment decisions. Welcome to the parallel economy. Today, we're diving deep into a topic that affects every single one of us. Inflation. Why does your money seem to buy less and less each year? And why do so many people believe that Bitcoin holds the answer to this problem? Stick around as we explain what inflation is, where it comes from, and how a digital currency born from a financial crisis aims to fight it. So, what exactly is inflation? Imagine it as a silent tax that slowly eats away at the value of your money. It's that frustrating feeling when you go to the grocery store and notice that the same items you bought last year now cost significantly more. It's not that the apples or the bread suddenly became more valuable. It's that the dollar in your pocket has lost some of its purchasing power. Prices go up because the value of money is going down. It's a subtle, creeping change that can have a massive impact on your savings and your financial future over time. To understand why inflation happens, we need to look at how modern money works. Most currencies today, like the US dollar or the euro, are what we call fiat currencies. This means their value isn't backed by a physical commodity like gold. It's backed by the trust we have in the government that issues it. When governments need to pay off debts, fund large projects, or stimulate a struggling economy, they have a powerful tool at their disposal. They can create more money out of thin air. This is often done through central banks, like the Federal Reserve in the United States. Think of it like this. If you have a rare collectible, its value comes from its scarcity. If someone suddenly flooded the market with thousands of identical copies, the value of your original would plummet. The same principle applies to money. When the central bank prints more currency, it dilutes the value of all the money already in circulation. The total amount of goods and services in the economy hasn't changed, but now there are more dollars chasing them. This abundance of money weakens its individual strength, causing prices to rise across the board. Scarcity gives money its power. Abundance takes it away. This entire system hinges on one critical element: trust. We trust that our central banks will act responsibly, carefully balancing economic growth with stable prices. We trust that they won't print money recklessly and devalue our savings. But history is filled with examples of this trust being broken. Let's take a quick trip back in time. In ancient Rome, emperors would debase their currency by melting down gold and silver coins and mixing them with cheaper metals to fund their wars and extravagant lifestyles. The result, the currency lost value, and the Roman economy suffered from severe inflation. Fast forward to the Weimar Republic in Germany after World War I. The government printed money at an astronomical rate to pay its war debts, leading to hyperinflation so extreme that people were using wheelbarrows of cash just to buy a loaf of bread. And it's not just ancient history. Many of us remember the high inflation of the 1970s in the United States, which eroded the savings of an entire generation. And today, we're once again seeing inflation become a major global concern. Time and time again, when political pressures mount, the temptation to print more money proves too strong. When that trust fails, the value of our money falls. This recurring cycle of trust and betrayal is the very problem that Bitcoin was created to solve. In late 2008, in the aftermath of a global financial crisis that shook faith in traditional banking systems, a mysterious person or group named Satoshi Nakamoto published the Bitcoin Whitepaper. The network officially launched in January 2009. Bitcoin was designed as a direct response to the flaws of fiat currency. Its most revolutionary feature is a fixed, predictable supply. There will only ever be 21 million Bitcoin. That's it. This rule is baked into the code itself. New government, no central bank, and no CEO can change it. It's not a promise from a politician. It's a mathematical certainty enforced by a global, decentralized network of computers. Its scarcity is guaranteed by code, not by trust in a fallible institution. Now, how does Bitcoin enforce this scarcity? Through a brilliant mechanism known as the halving. When Bitcoin was first created, individuals called miners would use their computers to validate transactions and secure the network. As a reward for their work, they would receive a certain number of new Bitcoins. This is how new coins enter circulation. But here's the genius part. The Bitcoin protocol dictates that this reward gets cut in half approximately every 4 years. When Bitcoin started, the reward was 50 Bitcoins per block. In 2012, it halved to 25. In 2016, it halved to 12.5. In 2020, to 6.25. And most recently in 2024, it halved again to 3.1 to 5. This process will continue until the last fraction of a Bitcoin is mined, sometime around the year 2140. This having cycled means that the rate at which new Bitcoins are created slows down over time. It's the complete opposite of inflationary fiat currencies, where the supply can be increased at will. Bitcoin has a built-in, predictable rate of disinflation. Over time, as the supply growth approaches zero, it becomes an inherently deflationary asset. It's deflation by design, a system programmed to become scarcer over time, not more abundant. So let's bring it all together. From the perspective of the parallel economy, we see two fundamentally different systems operating side. On one hand, you have traditional fiat money, which is infinite by policy. Its supply can expand based on the decisions of a small group of people. This system relies entirely on trust in those people to manage the currency responsibly. On the other hand, you have Bitcoin, which is finite by code. Its supply is fixed and unchangeable. This system doesn't ask for your trust. It asks you to verify the math. It runs on a transparent, open-source protocol that anyone can inspect. Inflation shows us what happens when the rules of money can be bent to serve political or economic goals. It erodes wealth and punishes savers. Bitcoin shows us what can happen when the rules are unbreakable. One system expands and dilutes, the other defends and preserves. It represents a shift from a system based on trust in authorities to a system based on mathematical proof. These are the same principles of sound money that have been understood for centuries, now built on new digital rails for the 21st century. Thanks for joining us on this deep dive. If you want more insights on how traditional finance and the world of crypto connect and collide, make sure to subscribe and hit that like button. This is the Parallel Economy. We'll see you in the next one!